Welcome in. Coming up on today's program, common investing mistakes people make, plus a very special investing in business bonus segment. This is What's Next with Money, a program with smart insights to guide your financial decisions. Let's get started. Now, here is some wisdom from Warren Buffett and his partner, Charlie Munger, Chair and Vice Chair of Berkshire Hathaway, from live note-taking I did at their annual meeting in Omaha, also known as the Woodstock for Capitalists. Now, I've been to several meetings, and I've been a Berkshire shareholder of B shares since the early 2000s. These are 3 tips to help you avoid costly mistakes in your stock market investing and in your life, plus that special bonus section. So here's the first. Too much buying and not thinking about the consequences of selling. This can get us into trouble. You know, right now it's really easier to buy than sell. Costs are low. We can do it on a mobile device or tablet. There are no or few barriers to buy. If we have ready cash, it is tempting to throw that into the market, especially when the market is going up. Unless you have a plan for that cash, and you can see my video on Can Cash Be an Asset, and we'll have a link to that. We do not generally have tax consequences when buying, but we often do when selling. Now, if you own a Roth IRA, you're not going to have those tax consequences. In a regular IRA or 401k, if the money is not withdrawn or distributed and you're buying and selling, very limited tax issues there. But if you pull the money out early, before age 59 and a half, you're going to get hit with ordinary income tax and a 10% tax penalty. In a taxable account, you have also tax consequences of short-term capital gains if it's held for under a year, or a year or more, long-term capital gains at a better rate. Now, more of that's covered in the video I did called Loser Stock, and I've got links to that. Now, for our older viewers, yes, ordinary income tax consequences from required minimum distributions, RMDs, from tax-deferred accounts, 401ks, IRAs, 403bs. Now, we're talking about common investing mistakes people make. Here's the next one. Not looking for a competitive advantage in the company or stock you are evaluating. Does the company and its management stay sane when their competitors are going or acting crazy? Does management constantly display emotional and business maturity and competence? The Berkshire Hathaway leaders, the managers, say they like companies and leaders who act like they would want to be treated if they were in a submarine on a long deployment. That's the test of emotional and managerial maturity they make. They ask questions like, if we acquire this company, or if we're investing big in the stock of this company, they look at the people that are leading it. Would they be good partners? Are the finances and ethics of the business solid? Would this company's competitors, my target company, would their competitors put those competitors' people in charge of their own business? In other words, is the company or the stock we are thinking about buying, is their talent pool so great that their competitors would say, I would like some of those leaders to run us, the people we're competing against? You know, we're talking about common investing mistakes people make. Now, here's another one on decision making. Don't make decisions when you're tired. Now, I would add stress, or without time to think or consult with your advisor, spouse, or business partners. Warren Buffett and Charlie Munger don't do that. They take time to talk and debate. A lot of times they act quickly, but they know the companies they're dealing with, and they've done this pre-debate. Now, when looking at a business to invest in or issues to address, here's a little technique, and I got this right out of my notes at Berkshire Hathaway meeting, that Warren and Charlie do. Now, let's take a look at this from companies they're thinking about buying or investing in. They'll make a list of the top 25 companies on a target list, and then they'll rank those and they'll drop the bottom 20 out. They'll focus on the top 5. And that's where they spend their energy dissecting and analyzing these companies. Also, at the annual meeting, they also said if you're dealing with a management challenge in a business you own, do the same thing. List the 25 top challenges. Drop the 20 and focus on the top 5. A lot of those 20 might take care of themselves by doing that, but you have limited time and limited focus. Now, there could be some real zingers inside there, like tax compliance, regulatory issues. Those ethical and governmental compliance issues must be dealt with. But in general, this is a way to achieve focus with investing, with life, and in management. So also they talk about the game of life involves lifetime learning. And part of this being not investing when you're tired or stressed, this helps you avoid working to the edge of your competency. Now, I would call that, from my perspective and my reading of annual reports of Berkshire Hathaway, The Intelligent Investor by Benjamin Graham, and many other books, it's important to have a margin of safety. Otherwise, you will skate yourself to the edge of fear, uncertainty, and doubt. Otherwise known as the FUD factor, F-U-D, fear, uncertainty, and doubt. This came from a financial planner friend of mine named Lou Walker in Atlanta, Georgia, CFP professional. So I mentioned we're going to have that special investing and business bonus section, and we're going to get to it right now. What I'm going to describe, and I think this can be helpful to a business or enterprise that you run, or even a corporation you work for. I want to share with you the 3 basic pillars of the Berkshire Hathaway company, how they operate, why their unique structure is so unusual. They basically consist of 3 areas, 3 typologies of investing. The first are wholly owned companies that they have bought. These are often private companies they've bought from a founder, or they're companies that were public. They bought all the shares and took them private. And there are many names that you'll know, and over the years, these are outlined in their annual report, and you can see all this online. But these names change periodically, but a lot of them are pretty steady. Duracell, Dairy Queen, BNSF, Burlington Northern Santa Fe Railway, See's Candy, Fruit of the Loom, NetJets, Berkshire Hathaway Energy. So that's the first category. These are businesses they own completely. Berkshire Hathaway has appointed their managers to the leadership positions, or they could be the managers that they feel are great, that want to stay managing when the companies were privately held. They kept those folks in control, and this avoided layoffs, big change of management, and it kept the legacy of the company intact. And that's why Berkshire's an attractive acquirer of these private firms. Let's move to the second area of the Berkshire Hathaway operations, the second typology. And this is called concentrated stock portfolio. A lot of what people in America and around the world think of Berkshire Hathaway is very wise investing in companies. Now, these are companies they do not own and they do not control, or there's going to be one exception I'm going to showcase. This is where Berkshire Hathaway has taken their extra free cash flow and they have bought major share positions in these companies. And some of these companies they've held for decades. Here's a short example, and the list is much longer in the annual report. American Express, Bank of America, Coca-Cola, Apple, Occidental Petroleum, Chevron, and Kraft Heinz. I mentioned Kraft Heinz at the end because they have a lot of actual control here. They work with other partners, and so they're in the 33 or higher percentage of ownership of Kraft Heinz. So it's a little special circumstance, but that company is still publicly traded. All these are publicly traded. We can buy investments in them. Now, these investments yield dividends and I'll talk in a moment about how they use that. Let me mention a couple of stocks I've heard Warren and Charlie talk about on stage live in front of the world, because the meeting is very international, that they missed. Google, Amazon. Here's why. And this will move to the third section of how the Berkshire business is structured. They advertise. Berkshire owns Geico and many other companies, and they advertise on the Google platform. And with Amazon, they have used Amazon's super division, Amazon Web Services, otherwise known as AWS, cloud computing. And here they're spending money writing checks for years and years to Google and Amazon for these services. And they admitted right under their nose were these fantastic investments. They had reason to know the companies, but it just didn't translate eventually to an investment in the category 2 of publicly traded companies. Now I'm going to move to the final area. And this is the third super area of Berkshire, and the one that's super unique. And that's their insurance business. And they list this, and they have really separate managers in this area. Insurance feeds cash into the Berkshire Hathaway company because they own Geico, General Re, and they just acquired a new insurance operation called Allegheny. Now, people pay premiums, and then there's reserves that are required to be held, but there's this thing called the float. These are extra cash that comes in, not required for reserves, and it's like free cash flow. And it's money that Warren and Charlie and their investment folks can use to buy stocks in category 2, publicly traded companies. They can use that money to buy in category 1, privately held companies, or take a whole company that's publicly traded private. So it's like this unbelievable economic engine. So in category 3, with this insurance money that flows in, they combine that in a cash pool with the dividend income from the securities they hold in number 2, and also the earnings or the free cash flow and they combine it with the dividends paid out in category 2, the publicly traded stocks, and then category 1, the privately held companies, flow off or inject free cash flow that's not reinvested in those businesses back to the company. So they have 3 sources of cash: the insurance float, the dividends from publicly held companies, and maybe the gains if they buy and sell there, and then the earnings or free cash flow not invested in some other way from the privately held businesses. And these become this giant cash hoard that Warren and Charlie use to go out and buy other companies, or they buy other positions in publicly traded securities. Or in a recent case, they bought another insurance company. Now, why am I so excited about this? Because it's such a unique structure. Berkshire Hathaway doesn't even pay a dividend. In their A shares, they've never split the stock. That's why people see it's so big. But they do have B shares that allow people like me to invest. Can we take any analogy or categorical thinking of this structure and apply it to a household, or maybe a household that has a business? So all I'm going to do is just say category 1, privately held companies Berkshire has. Think about that as a private business you might own, a side gig, something that generates income. It could even be a real estate investment, but it could be a business. Category 2, all of us can do this. We can invest smartly in publicly traded companies, ETFs, mutual funds, even real estate investment trusts. Now, what's the deal with the third category, the insurance company? I don't think many of us are going to buy an insurance company or invent one. But what could we own that throws off cash? I think one of the great things that could happen is real estate. So if you own rental property, commercial property, or some other form, land leases, you name it, that money, after debts are paid off, the free cash flow from that can then be pooled where you could buy additional securities in category 2 or enhance the small business you're running in category 1. So I wanted to share that with you because the learning with Berkshire Hathaway, all these great leaders, and look at this. Here's Warren Buffett on a Coke can from another country. I mean, this stuff never stops. And it's global. These gentlemen are respected for their longevity, for their ethical thinking in business. But think about the power, the interplay of this business formula that seems nearly unrivaled with any other publicly traded stock in the world. What can we learn from it besides all the great writings and analysis? And more of these I'm going to share in future videos. But the structure of the business, it's so powerful. And I have actually been able to, fortunately, slowly try to mirror some of that three-part interplay to generate cash and then to do certain things through investing in new areas and ultimately for charitable purposes. And charity is really the end game for Warren and Charlie, certainly for Warren, as he's given nearly 90+% of his wealth away through different foundations, a lot through the Gates Foundation, and his children also have their own foundations that they're running. So the bottom line is these guys love their work. Their mental acuity is so sharp, and it reflects one of their great advice pillars. Take the job you would take if you did not need the money. And I feel really privileged to speak to you through YouTube because I'm doing that through YouTube, board service, public issues, policy, media work, charity, and investing and running a small business. I kind of get to live that. Now, it took many years to get there. And my wife of 40 years and family, adopting older kids out of foster care, now with grandkids. This took a lot of work, but the focus is on lifelong learning. And I have the privilege and that job of loving what I do. So be sure to hit that subscribe and like button. And don't forget to share. Remember, new episodes of What's Next with Money are posted on Thursdays.